Payments to connected persons and their deductibility for corporate tax purposes. Under the UAE corporate tax law, payments or benefits provided by a taxable person, i.e., a business entity subject to corporate tax, to its connected persons are subject to specific rules regarding their deductibility for tax purposes. These payments or benefits can only be deducted to the extent that they meet certain criteria, ensuring that the transactions are conducted in a manner consistent with market practices and for legitimate business purposes. Conditions for deductibility of payments to connected persons. To determine whether a payment or benefit provided to a connected person is deductible, the following key conditions must be satisfied. 1. Correspondence with market value. The payment or benefit must correspond with the market value of the service or benefit provided by the connected person. In other words, the amount paid must be in line with what would be paid for similar services or benefits in an open market transaction between unrelated parties. This ensures that the transaction reflects an arm's length arrangement, a standard commonly used in transfer pricing to avoid manipulated or inflated pricing between related parties. For example, if the owner of a business, who is also a connected person, receives a salary, this salary will be deductible only if it corresponds with the market value of what an independent third-party employee would be paid for the same work. 2. Incurring the payment for business purposes. The payment or benefit must be incurred wholly and exclusively for the purposes of the taxable person's business. If the payment or benefit serves personal interests or is not directly related to the business operations, it will not be deductible. This ensures that the tax deductions are linked directly to the business's economic activities and are not used to shift profits or reduce taxable income through personal expenses disguised as business costs. Application of the arm's length principle. The arm's length principle is a critical concept in determining whether the value of services or benefits provided by connected persons aligns with their market value. This principle requires that the terms and conditions of transactions between related parties or connected persons should be comparable to those that would have been agreed upon in a transaction between unrelated parties in an open and competitive market. Essentially, it ensures that the terms of the transaction are fair and reasonable, reflecting what would occur between independent businesses or individuals. Definition of connected persons. The term connected persons covers a broader range of relationships than the term related parties. A connected person of a taxable person is generally defined as an individual or entity with a personal or ownership link to the business. These include 1. Natural persons with ownership or control. A natural person who directly or indirectly owns an ownership interest in, or controls, the taxable person is considered a connected person. For example, if an individual owns a significant portion, example more than 50%, of the shares in a company, or has the ability to direct or influence its decisions, that individual is a connected person to the company. 2. Directors and officers. Directors or officers of the taxable person, such as the managing director or CEO of a company, are also considered connected persons. These individuals hold positions of authority and decision-making power, directly affecting the operations and management of the company. 3. Related parties of the above. The related parties of the above individuals, example, family members such as spouses, children, or siblings, are also classified as connected persons. This ensures that the business dealings between a company and those with a direct or indirect personal interest are subject to the same scrutiny as transactions with related parties. Exemptions for listed companies and regulated entities. There are exceptions to this rule for certain businesses. Publicly traded companies. The limitation on deductions for payments to connected persons does not apply to companies whose shares are traded on a recognized stock exchange. This is because such companies are subject to public disclosure requirements, and their transactions are generally subject to more oversight, reducing the risk of manipulation for tax advantages. Regulated businesses. The restriction on deductibility also does not apply to taxable persons that are subject to the regulatory oversight of a competent authority in the UAE. For example, businesses that operate in regulated industries may have specific compliance and reporting requirements that ensure their transactions are conducted at arm's length and in the public interest. Example 21. Related parties, control, and connected persons. To better illustrate the concept of related parties and connected persons, consider the following example. Mr. B is a first cousin of Ms. C. Mr. B owns 75% of B LLC. Ms. C owns 20% of C LLC, and she holds preferential shares that entitle her to 60% of the voting rights in C LLC. Additionally, Ms. C is a partner in JKL Partners, an unincorporated partnership, where the other partner is a UAE corporation, DLTD. Here is how the relationships work under the connected persons and related parties definitions. Mr. B and Ms. C are related parties because they are related to the fourth degree of kinship, i.e., first cousins. Mr. B and B LLC are related parties because Mr. B owns more than 50% of B LLC. Mr. B and C LLC are connected persons because Mr. B is related to Ms. C, who owns more than 50% of the voting rights in C LLC. Ms. C and C LLC are related parties because Ms. C controls C LLC, owning more than 50% of the voting rights. Ms. C and D Ltd are related parties because they are partners in the same unincorporated partnership. B LLC and D Ltd are unrelated juridical persons, as they do not share ownership or control ties. Ms. C and B LLC are connected persons because Ms. C is Mr. B's first cousin, and Mr. B owns more than 50% of B LLC. This example highlights how the concepts of related parties and connected persons intersect and how transactions involving these parties may be subject to additional scrutiny under UAE corporate tax laws, particularly in relation to the deductibility of payments or benefits.